Imagine opening a financial document for an upcoming IPO. You're expecting the usual, dry corporate metrics, profit margins, supply chain logistics, maybe some standard risk disclosures.
Right, the standard stuff,
Exactly. Instead, buried in the fine print, you find a legally binding performance clause requiring the construction of a permanent million-person city on Mars.
which is just, it's completely unprecedented.
It is. And if you don't build the Martian city, the CEO doesn't get his bonus.
Oh.
That is not science fiction. That is literally written into the 600-page prospectus for the SpaceX initial public offering.
Yeah, it's really something else.
We are talking about what is arguably the most highly anticipated, massive financial event in modern history. A target raise of $75 billion, a staggering $2 trillion valuation on day one.
And that's just day one.
Right. And a total addressable market, their TAM, the total revenue they believe they can eventually capture, listed in the prospectus at $28.5 trillion. For context, the entire gross domestic product of the United States is around $27 trillion.
It is the absolute definition of a paradigm shift. What's fascinating here is that we are not just looking at a company raising capital to build widgets. We are looking at an entity trying to privately finance the multiplanetary future of the human species.
Yeah, which sounds amazing, but
But they are asking retail investors to foot the bill under some of the most extraordinary restrictive terms ever committed to paper.
exactly. And that is the mission of our deep dive today. We aren't just reading the headlines or, getting swept up in the hype of rocket launches. We are tearing through this massive SpaceX IPO prospectus to decode the legal fortresses, the hidden financial maneuvers, and the sci-fi level ambitions lurking in the fine print.
There's a lot hiding in there.
Oh, absolutely. But real quick, before we jump into the numbers, a quick note. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join the deepvalues.ai community.
Always a great resource.
Yeah, and to track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
And a quick reminder for you, our listener. All analysis today is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel are for information and research purposes only and do not constitute investment advice.
Right, definitely do your homework.
Conduct your own due diligence before making investment decisions. If you like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
Okay, so let's unpack this. If you are out there thinking of buying in, if you want a piece of this $2 trillion pie on opening day, you absolutely need to hear what's actually under the hood.
Because it's not your typical offering.
Not at all. Give us the high-level view of what this document really is, because it doesn't read like a normal S1 filing.
It doesn't, because it isn't just a business plan. It is a masterclass in blending extreme world-changing engineering with extreme financial leverage and control.
Control being the key word there.
Exactly. At its core, the central tension of this document is between the awe-inspiring physical achievements of the company landing rockets backward, beaming internet from space, and a governance structure specifically engineered to strip the public investor of almost all traditional rights.
Wow.
Yeah, it's an entirely new kind of corporate architecture.
Well, let's dive straight into that architecture, specifically this idea of control. Because for anyone buying stock, there's a baseline assumption of how American capitalism works.
Right.
You buy shares, those shares give you voting rights, you pool those votes to elect a board of directors, and that board acts as your representative to oversee the CEO. It's a basic system of checks and balances, right?
That is the standard three-tier system. Shareholders at the top, the board in the middle acting as the fiduciaries, and the executive management at the bottom executing the vision.
Makes sense.
In a standard mega-cap tech company, say Apple or Microsoft, they use a single-class share structure. One share equals one vote. Tim Cook holds less than 1% of the voting power at Apple.
Oh, really? I didn't realize it was that low.
Yeah, the other 99% is held by external shareholders. So if the board fails in its duties, or if Cook makes terrible strategic decisions, the shareholders have the mathematical power to vote them out.
But SpaceX is radically departing from that. They are utilizing a superclass share structure. If you go to your brokerage app on IPO day and buy a share of SpaceX, you are buying a Class A share.
And what does that get you?
That gives you exactly one vote. But there are Class B shares held almost entirely by Elon Musk, and those get 10 votes per share.
Right, the 10-to-1 ratio.
Exactly. Because of this 10-to-1 ratio, the prospectus reveals Musk holds 85.1% of the total voting power of the entire company.
Which is massive. But, if we connect this to the bigger picture, this dual-class structure isn't entirely unprecedented. Google famously implemented it in 2004, and Meta did it shortly after.
True, they kind of set that trend.
They did. The original philosophical argument was to protect visionary founders from the short-term, quarter-by-quarter pressure of Wall Street. It theoretically allows a founder to focus on a 10-year horizon without worrying about activist hedge funds staging a boardroom coup because they missed a quarterly earnings target.
Right, like Mark Zuckerberg, for instance, has about 62% of the voting power at Meta.
Exactly.
But 85.1% is an entirely different stratosphere of control. And reading through the charter, that 85% isn't even the most aggressive part. There's a structural defense mechanism built into the paperwork that acts as a second layer of armor.
No, absolutely, because even with 85% of the vote today, share dilution is a mathematical reality over time.
Yeah, they're going to have to issue more stock eventually.
Right. If SpaceX decides to issue massive amounts of new stock over the next decade to acquire other companies or to fund these massive capital expenditures we'll talk about later, that 85% could theoretically drop below 50%.
So what do they do?
So, SpaceX's legal charter explicitly states that Class B shareholders, meaning essentially Musk alone, get to elect more than half of the board of directors no matter what.
Wait, no matter what their actual voting percentage drops to.
No matter what, specifically 5 out of the 8 seats. The Class A shareholders, the public who puts up the $75 billion, have absolutely zero say in these 5 seats. You don't even get a ballot for them.
It's like setting up a rigged election system where it doesn't matter how many new citizens move into the town. The mayor legally has the right to unilaterally appoint the majority of the city council forever, regardless of the population.
That's a really good way to put it.
So mathematically, his voting percentage could dip to 10%, and he still legally owns the boardroom. Let's look at who is actually sitting in that room. There are 8 members total. 3 are non-independent, meaning they're company insiders. Musk himself, President Gwynne Shotwell, and Antonio Gracias.
Right.
That leaves 5 supposedly independent directors.
And here is where the legal definition of the word independent gets stretched to its absolute breaking point. Remember those 5 board seats that are exclusively elected by the Class B shares?
Yeah.
Musk uses that unilateral power to appoint the 3 insiders plus 2 of the independent directors.
Okay.
The remaining 3 independent directors are technically voted on by all shareholders. But since Musk holds 85.1% of the total general vote anyway, he essentially dictates the outcome for those 3 as well. He controls the entire room from top to bottom.
I looked into the backgrounds of these supposedly neutral directors, and these are not exactly impartial arbiters. We are looking at a roster of ultimate superfans.
To put it mildly.
Yeah. You have Steve Jurvetson, who has a 30-year friendship with Musk. Jurvetson bought the very first Tesla Roadster ever made, and the very last one. Back in 2008, when Tesla is days away from bankruptcy, Jurvetson was the guy out there hustling to save it.
A very loyal ally.
Extremely. Then you have Ira Ehrenpreis, a 20-year ally. You have Luke Nosek, who co-founded Founders Fund and literally launched a special purpose vehicle called GigaFund just to funnel continuous capital into SpaceX. These guys have made vast fortunes betting on Musk. Their loyalty is absolute.
Which is highly effective for a scrappy, private startup trying to survive early rocketry failures. But it is highly problematic for a $2 trillion public entity asking for retail investment.
Right, because the rules change when you go public.
Exactly. In a normal public company, the CEO answers to the board. At SpaceX, the CEO effectively is the board. The traditional institutional checks and balances do not exist here. The director's continued presence in that room is entirely dependent on the goodwill of the CEO they are legally mandated to oversee.
So if you are buying SpaceX stock, you have to understand the reality of what you own. You are buying an economic ticket to a roller coaster. You get to experience the highs, the lows. You are entitled to the financial gains, but you are completely locked out of the steering cabin.
You're just along for the ride.
You have zero voice. If the company decides to issue 1 billion new shares tomorrow and dilute your value by half, you cannot stop it. If they decide to buy a failing company for $60 billion using your equity, you cannot vote against it. You are purely a passenger.
And that total lack of oversight becomes critically important when we examine how this specific board handles the company's checkbook. Governance isn't just an abstract legal concept. It dictates where the money flows.
Which is where things get really crazy in this prospectus.
Yeah, the way SpaceX manages conflicts of interest is, frankly, unprecedented for an IPO of this scale.
Let's get into the weeds on that, because the way they're handling executive compensation and related party transactions blew my mind. We need a quick history lesson first, though. In the early 2000s, the stock market was rocked by massive corporate scandals, Enron, WorldCom.
Right, the big ones.
These were titans of industry that completely evaporated because executives were hiding debt and inflating profits, while friendly, hand-picked boards just looked the other way and signed the checks.
Yes. Enron was a $100 billion energy juggernaut that collapsed into bankruptcy in a matter of months due to systemic accounting fraud. And the post-mortem investigations revealed a glaring flaw in corporate America.
Which was?
Well, while Enron technically had independent directors, those directors were far too close to management. The audit committee, the compensation committee, they just rubber-stamped whatever the CEO wanted because they lacked true independence.
So, to stop that from ever happening again, Congress stepped in and passed the Sarbanes-Oxley Act, commonly known as SOX.
Correct. The SOX Act fundamentally rewired corporate governance. It legally mandated that the audit, compensation, and nominated committees of a public board must be composed entirely of genuinely independent directors.
Meaning no company executives.
Right. No company executives, no major shareholders, and absolutely no one with significant financial ties to the company's management. The idea was to create a rigid firewall. If the CEO wants a massive bonus or wants to appoint a new director, they have to convince a room of people who have zero financial incentive to just blindly say yes.
Wait, hold on. If SOX was designed to prevent another Enron, how is SpaceX legally bypassing it? Because reading the prospectus, they are completely ignoring the requirement for independent compensation and nominating committees. Is this just a loophole, or are they daring the SEC to sue them?
This raises an important question about legal exemptions. It is a known loophole. SpaceX is utilizing what the SEC calls the controlled company exemption.
How does that work?
The rule states that if an individual or a group holds more than 50% of the voting power, the company is exempt from the requirement to have a majority independent board, and critically, they are exempt from having independent compensation and nominating committees.
That seems...
The logic, flawed as it might be, is that if one person owns the majority of the company, they're primarily risking their own capital, so they don't need the same paternalistic protections from the government.
That seems completely backwards. The law meant to protect public investors from dictators says, well, if the CEO is an absolute dictator with 85% of the vote, we won't make him use independent committees. That defeats the entire purpose of the firewall.
It is a highly controversial exemption. Early on, companies like Google and Meta qualified for it, but in practice, they generally still try to staff those critical committees with independent directors just to maintain good optics, build market trust, and appease institutional investors.
But not SpaceX.
No, SpaceX is taking the opposite approach. They are fully utilizing the exemption to its maximum legal limit.
And the absolute poster child for this utilization is Antonio Gracias. Let's talk about Antonio, because this is where the conflict of interest becomes staggering. He is a director on the board. He sits on both the compensation committee and the nominating committee, but he is a designated insider.
He is.
He is the founder and CEO of a massive private equity fund called Valor Equity Partners. And buried in the prospectus is a disclosure that Valor has signed 3 equipment lease agreements with a SpaceX subsidiary called XAI, totaling $20 billion.
Let the mechanics of that number sink in. $20 billion.
It's just an unfathomable amount of money.
The setup works like this. Valor Equity Partners uses its capital to buy massive amounts of AI computing, hardware servers, GPUs, networking gear. They then lease all of that hardware back to SpaceX's AI division on a monthly basis.
Wait, so...
This means a sitting board member who serves on the very committee that dictates the CEO's salary, and the committee that decides who else gets to be on the board, is simultaneously running an outside fund that is extracting billions of dollars in lease payments directly from the company.
If I'm a retail investor looking at this, my immediate thought is, why in the world is SpaceX, a company that is about to raise $75 billion in cash from the public, renting its servers from its own board members' private equity firm?
It's a very fair question.
Right. Why not just buy them directly or finance them through a traditional bank? The optics are incredibly conflicted.
It is the textbook definition of a related party transaction, and it illustrates exactly why the SOX Act originally mandated independent committees. Because you have to ask the logical question, how can Antonio Gracias objectively and aggressively negotiate the CEO's compensation package on behalf of the shareholders when his own outside fund relies entirely on that same CEO's ongoing approval to maintain a $20 billion revenue stream?
He can't.
Human nature and financial incentives suggest that it's an impossible tightrope to walk.
And speaking of that compensation package, let's look at what Gracias and the rest of the compensation committee actually approved for Musk. The prospectus states Musk's base salary is $54,080.
Yeah.
which is purely theatrical, right? It's tied to the 2019 California minimum wage.
Purely theatrical. The actual compensation is structured in two unprecedented milestone-based equity packages. Together, they represent the authorization of 400 million brand new Class B shares.
And what's that actually worth?
Well, based on the target IPO valuation and the inherent premium placed on 10-vote shares, this compensation package could ultimately be worth well over $200 billion.
$200 billion for one person. And the milestones to unlock this stock. They don't even sound like traditional business metrics. Usually you see things like achieve a 15% operating margin or grow revenue by $5 billion. These sound like victory conditions for a sci-fi video game.
They really do. The first package is dubbed the SpaceX CEO Award. It triggers in escalating tranches as the company's market capitalization grows to $1.75 trillion.
Okay, so a market cap goal.
Yes, but there's an operational milestone firmly attached to it. To unlock the final tranches, the company must successfully establish a permanent, self-sustaining human colony on Mars, and the total population of that colony must reach at least 1 million people.
A million people on Mars. As a corporate performance metric to unlock a stake bonus, how do accounts even audit that? Do they send PwC auditors to Mars to do a head count? It is wild.
The audacity of the goal is the point. And the second package is the AI CEO Award. This one triggers as the market cap scales up to an astronomical $6.565 trillion.
That's a massive valuation.
It's huge. And the operational requirement here is equally staggering. The company must successfully build and deploy a non-Earth data center, meaning a facility in orbit or in deep space, with a 100 terawatt compute capacity.
Okay, so let's synthesize this. You have a board member making billions off the company through a private equity lease. That same board member approves a $200 billion pay package tied to building a Martian city and space supercomputers. If a normal institutional shareholder, say, a massive pension fund, looks at this and says, this is insane, this is a gross breach of fiduciary duty, we're going to sue the board, what actually happens?
Nothing happens. Because the prospectus has engineered a legal fortress specifically designed to prevent shareholder litigation. First, the corporate charter completely bans class action lawsuits.
Wait, completely bans them. That is massive. Class actions are effectively the only weapon retail investors have. If I lose $5,000 because a company blatantly lied on its financials, I cannot afford to hire a corporate litigator to fight a $2 trillion megacorporation.
No, you can't.
But if 100,000 people pool their $5,000 claims together, a major law firm will take the case on contingency. That exact mechanism is how investors clawed billions of dollars back from the executives at WorldCom and Enron. SpaceX just deleted that entire mechanism from their reality.
Exactly. The charter mandates that all shareholder disputes, no matter how egregious the claim, must go to mandatory binding arbitration on an individual basis. Furthermore, if a large shareholder wants to file what is called a derivative suit,
What's that?
it's a specific legal action where a shareholder sues the board of directors on behalf of the company itself for gross negligence or self-dealing. The charter imposes an almost impossible threshold for that. It requires that the complaining shareholder must individually hold at least 3% of the total voting power of the company, and they must have held it continuously for 6 months prior to the lawsuit.
Let's do the math on that 3% of the voting power. In a company valued between $1.5 to $2 trillion, 3% is roughly $45 to $60 billion worth of stock.
That's astronomical.
There is not a single retail investor on Earth, and frankly, there are very few institutional asset managers in the world who hold a $60 billion position in a single stock individually. They have literally set the barrier to entry for a lawsuit higher than the GDP of dozens of countries. It's a fortress designed to communicate one thing clearly. You literally cannot sue us, ever.
Which brings us to the ultimate synthesis of the governance side of this prospectus. Investors might look at this structure, the total loss of voting rights, the heavily conflicted board, the $20 billion related party loopholes, the astronomical compensation, the absolute ban on litigation, and they might swallow all of it.
They might just accept it.
They might accept these draconian terms without blinking. But they will only do so if the underlying business, the actual engine generating revenue, is an absolute unstoppable juggernaut that justifies the dictatorship.
Right. History shows people will put up with an autocrat if the trains run on time and the stock portfolio goes up 1,000%. So let's look at the actual business, the engine room, the rockets, and the Starlink cash cow.
Now let's start with the launch vehicles, because this is the foundational technological mode of SpaceX. To understand the economics here, we have to look back before 2010.
Okay, set the scene.
The entire global aerospace industry, NASA, the ESA, Boeing, Lockheed, operated on a single, incredibly wasteful paradigm rockets were expendable.
Meaning they just threw them away.
Exactly. You
Yeah.
build a multi-million-dollar machine, it flies exactly once, it drops its payload into orbit, and the rest of the multi-stage rocket either burns up in the atmosphere or crashes into the ocean to sink.
Which is an insane business model when you think about it. It's like buying a brand new Boeing 747, flying a load of cargo from New York to London, and then throwing the airplane in the trash the moment it lands. It made the economics of spaceflight impossibly expensive.
It did.
But SpaceX fundamentally changed the laws of physics, or at least the economics of physics. In 2015, they did the impossible. They successfully landed the first stage of a Falcon 9 rocket on a drone ship in the ocean. They proved you could fly, land, refurbish, and fly again.
The economic impact of that engineering breakthrough cannot be overstated. According to NASA data cited in the analysis within the prospectus, the reusable Falcon 9 reduced the cost of launching a kilogram of mass into low Earth orbit from roughly $18,500 down to $2,700.
That is an 85% collapse in costs.
But because the rockets are reusable, they can fly with a frequency no one else can match. By the end of the first quarter of 2024, SpaceX had completed roughly 650 orbital launches. To put that scale in perspective, they are currently launching more mass to orbit than all other nations, including the combined efforts of China and Russia and all other private companies combined, multiplied by 4.
It is a total, undisputed monopoly on access to Earth's orbit. But here's the crazy part I found in the financials. The launch business, the very thing they are famous for, the thing they have a monopoly on, actually loses money.
It does.
In Q1 of 2024, the rocket launch division had $610 million in revenue, but posted a $660 million operating loss. How is it mechanically possible to lose money when you dominate the market and have the cheapest rockets in history?
The answer is Starship. Falcon 9 is the workhorse paying the daily bills, but Starship is the future of the company. It is a massive 124-meter-tall vehicle powered by 33 Raptor engines designed to be fully and rapidly reusable and capable of carrying over 100 tons to orbit.
It's just a monster of a rocket.
It is the absolute linchpin for every other ambitious project the company has, from the Mars colony to launching the next generation of massive satellites to lifting those 100-terawatt space data centers. But the research and development required to tame that beast is a financial black hole.
How much are we talking?
The company burned $3 billion on Starship R&D in 2023 alone. In just the first quarter of 2024, they burned another $930 million on it.
So the rockets are bleeding cash to build bigger rockets. If the core launch business is losing money, where is the actual cash coming from to keep the lights on? Enter the cash cow, Starlink.
Starlink is the true economic engine of SpaceX today. By aggressively launching their own payloads on the Falcon 9, they have put 9,600 Starlink satellites into low Earth orbit. They've created a dense planetary mesh network for internet access.
And 9,600 satellites,
Those 9,600 satellites represent an astounding 75% of all active satellites currently orbiting Earth.
It's incredible. They essentially own the sky. They cover 164 countries. If you are a soldier in a war zone in Ukraine, a doctor in a remote village in Nigeria, or a researcher on a boat in the middle of the Pacific Ocean, you buy a terminal, point it at the sky, and you instantly have high-speed broadband.
And the consumer growth is explosive.
Yeah. The prospectus notes subscribers doubled from 5 million to 10.3 million in just a single year.
And the financials clearly reflect that explosion in adoption. In 2023, Starlink generated $11.4 billion in revenue, producing an operating profit of $4.4 billion. That is a 39% operating margin.
39%. That is nearing Apple territory. That is software as a service level margins on a business that requires launching thousands of pieces of heavy hardware into space. So Starlink is like the highly responsible older sibling working a lucrative corporate job to pay the family mortgage, while the younger siblings, the rocket division and the AI division, are out in the garage spending billions building sci-fi projects.
That is a highly accurate analogy. However, if we dig deeper into the prospectus, it reveals a very concerning trend hidden just beneath Starlink's explosive subscriber growth. It's a metric called ARPU, average revenue per user.
And looking at the chart, it is dropping like a rock. In 2022, the average Starlink user was paying $91 a month. In 2023, that dropped to $81. By Q1 of 2024, it was down to $66. That is a massive slide in pricing power. Why is it falling so fast?
There are two main mechanics driving that drop. First, international expansion. To conquer the globe and hit that massive $28.5 trillion total addressable market, Starlink has to aggressively move into emerging markets.
Right, because people in different countries have different purchasing power.
Exactly. A satellite terminal that sells for $500 in the US has to be heavily subsidized by the company to sell in a developing nation like Nigeria. Furthermore, a monthly subscription that easily commands $120 in California might only pull in $50 in Brazil or India.
And what's the second mechanic?
Second, they are actively introducing cheaper domestic tiers, like a $50 per month rural plan, to capture lower income demographics within the United States.
So what does this actually mean for the bottom line? It means they are growing their overall user base by an impressive 105% year over year. But because the price per user is falling so rapidly, their actual operating profit only grew by 15%.
Which means they have to work harder.
Exactly. They have to run twice as fast, launching twice as many satellites and selling twice as many terminals just to stay in place financially.
Precisely. The theoretical scale dividend is being eaten alive by price compression. And to fight this, to find a new vector for massive growth, SpaceX is making another incredibly expensive pivot, direct-to-cell technology.
Oh, this is fascinating.
They want your normal, unmodified smartphone to connect directly to a Starlink satellite overhead, completely bypassing traditional telecom cell towers. But to legally do this, they needed spectrum rights, the specific radio frequencies permitted by governments to transmit cellular data.
And they didn't just apply for those spectrum rights, they bought them outright. The prospectus shows they spent $19.6 billion acquiring a legacy telecom company called EchoStar just to get their hands on those spectrum rights. $19.6 billion just for the legal right to use invisible radio waves.
It's a huge gamble.
But if you thought $19 billion for radio waves was a big gamble, wait until we look at the true sci-fi heart of this document. This is perhaps the most shocking revelation for the average investor.
It absolutely is, because SpaceX executed what accountants call a reverse acquisition under common control. This is a complex accounting maneuver where entities controlled by the same majority owner are merged.
So what did they merge?
In this case, they essentially folded Elon Musk's social media platform X, formerly Twitter, and his artificial intelligence startup XAI, directly into SpaceX's consolidated financials.
Walk us through how that actually works, because if you're an investor, you think you're buying a space company, but you're actually funding an all-out trillion-dollar war for AI supremacy on Earth.
That's exactly what's happening.
Let's look at the numbers for this newly merged AI division. In 2023, it brought in $3.2 billion in revenue, mostly from advertising and premium subscriptions on X, but it lost $6.4 billion operating the business.
The operating loss is staggering, but the capital expenditure, the CapEx, the money spent on physical assets, is the real story here. In 2023, the AI division spent $12.7 billion on CapEx. In just the first quarter of 2024, they spent $7.7 billion.
That's just wild.
They're buying graphical processing units, the specialized GPUs required to train large language models at a rate that is difficult to fully comprehend.
They're buying NVIDIA chips like they're going out of style. And what they're doing with them is where the unique SpaceX engineering moat comes in. We talked about how SpaceX builds rockets faster and cheaper than NASA. They're applying that exact same hardcore, rapid iteration engineering culture to building AI data centers.
The prospectus details the construction of a facility named Colossus One. This is a massive supercomputer cluster utilizing 100,000 NVIDIA H100 GPUs. For context, it normally takes industry giants like Amazon's AWS or Microsoft Azure over a year, sometimes two, to design, permit, build, supply power to, and network a data center of that colossal scale.
But SpaceX didn't take a year.
No, SpaceX retrofitted an abandoned factory in Memphis and brought Colossus One online in exactly 122 days.
122 days. That breaks every rule of traditional infrastructure development. And they are already building Colossus 2, which the prospectus says will use hundreds of thousands of the next generation NVIDIA GB200 and GB300 chips, and they plan to deploy it in a matter of months.
They're moving at rocket speed in a silicon world.
Literally.
If they can deploy compute infrastructure 5 times faster than the legacy cloud providers, they effectively become the ultimate neo-cloud, offering compute power to AI startups faster than anyone else.
And they already have their first mega client to prove the model. The prospectus outlines a massive compute contract with Anthropic, one of the world's leading AI foundation model companies. Anthropic has agreed to pay SpaceX an astonishing $1.25 billion per month for access to this compute power.
Per month.
Yes. If the contract runs its full anticipated course to 2029, it is worth up to $45 billion.
That immediately makes Anthropic one of SpaceX's largest single sources of revenue. But, and there is always a but, when reading the fine print of this prospectus, there was a massive catch.
There usually is.
The contract has a 90-day rolling cancellation clause.
Wait, Anthropic can just cancel? They can walk away with essentially 3 months' notice. That is an incredibly fragile foundation for a $45 billion projection.
It is extreme high risk, high reward. Furthermore, the prospectus details a complex buyout option with a company called CoreWeave, which is a specialized AI cloud provider. SpaceX has secured the option to acquire CoreWeave for $60 billion.
Okay, but what if they don't?
If SpaceX chooses not to execute that buyout by the deadline, they are legally hit with a $10 billion penalty fee.
So they're willingly locking themselves into these massive multi-billion-dollar binary decisions. But let's look at the ultimate endgame here. Why is a space company getting this deeply involved in AI? It's not just to compete with Amazon and Google on Earth. It's about the space data centers.
Yes, the 100 terawatt vision we mentioned earlier in Musk's compensation package. If we connect this to the physics of the real world, earthly data centers are currently constrained by three insurmountable physical limits.
Land, water, and power, right?
Exactly. Land to build on, massive amounts of water required for cooling the chips, and most importantly, power from the electrical grid. AI models are becoming so massive they are literally running out of electricity to train them. Entire cities cannot support the gigawatts needed.
But in space, you have zero land constraints. You have the vacuum of space, which is incredibly cold, making cooling virtually free. And most importantly, you have the sun.
Unfiltered, unlimited solar radiation. By deploying massive solar arrays in orbit, you have access to a constant, inexhaustible power supply that never experiences nighttime or weather interruptions.
Which solves the power problem entirely.
Right. The physics of beaming data down are complex, involving advanced laser communications to mitigate latency, but the goal is clear. SpaceX wants to launch AI compute clusters into orbit, beam the data up and down via the Starlink constellation, and completely bypass the terrestrial power grid and regulatory environment.
It sounds like the plot of a sci-fi blockbuster, but to launch thousands of tons of servers and solar panels into space, you need cheap, massive, heavy lift capacity. Which brings us full circle right back to Starship. Every single thread in this company, Starlink's growth, the AI, space, data centers, the Mars colony, it all relies on Starship successfully flying regularly and reliably.
It's a vertically integrated dream, a closed-loop ecosystem of technology. But that ecosystem requires capital. Mountains and mountains of capital.
It's not cheap.
The cash burn required to sustain the rocket R&D, heavily subsidized Starlink terminals globally, and by hundreds of thousands of AI GPUs is astronomical, which logically leads us to the true financial reality of this company and the deeply hidden reason for this IPO.
Let's talk cash flow, because this is where the math gets scary. In 2023, SpaceX generated $6.8 billion in operating cash. That's the actual money coming in the door from selling internet and launching rockets. But as we mentioned, they spent $20.7 billion in CapEx on chips and Starship.
Right, which leaves a gap.
A massive gap. That leaves them with a negative free cash flow of roughly $14 billion for the year.
And the burn rate is accelerating at an alarming pace. In Q1 of 2024 alone, they burned $9 billion. If you extrapolate that trajectory, they're pacing for a $30 billion to $40 billion cash hole this year alone. You cannot sustain that level of burn without massive external funding, regardless of how visionary the CEO is.
Which explains the debt. The balance sheet shows SpaceX is carrying $29.1 billion in long-term debt. Pre-IPO, their debt-to-equity ratio is sitting at a terrifying 84%. In the tech world, unless you are Apple buying back your own stock to artificially lower your equity base, an 84% debt ratio is a massive red flag.
It is a highly stressed, over-leveraged balance sheet.
Very stressed.
And the most critical, immediate piece of that debt is a specific $20 billion bridge loan. A bridge loan is exactly what it sounds like, short-term financing meant to bridge a company to a larger liquidity event, like an IPO.
Right.
SpaceX took this loan out recently to pay off the high-interest debt that was saddling the X and X AI entities when they were merged in. The bridge loan carries a 5 to 6% interest rate, which is relatively favorable, but it is fundamentally a short-term lifeline.
And who provided this $20 billion lifeline? 5 major investment banks: Goldman Sachs, Morgan Stanley, Bank of America, Citi, and JP Morgan.
Now, here's where we must examine the internal mechanics of Wall Street. The IPO prospectus contains a mandatory use of proceeds clause.
And what does that mandate?
It legally dictates that the very first dollars raised in this $75 billion IPO must be used to completely pay off that $20 billion bridge loan within 6 months of the offering.
Okay, so the company raises money from the public and immediately hands $20 billion right back to those 5 banks. Now, guess who the lead underwriters are for this exact IPO? Guess who is charging massive percentage fees to manage the sale of these shares to the public?
Well, I guess it is the exact same 5 banks: Goldman, Morgan, Bank of America, Citi, and JP Morgan.
Wait, that is brilliant daylight robbery. Imagine the bankers sitting down with Elon. Hey, we see you're burning billions on AI chips and giant rockets. We'll give you a great rate on this $20 billion bridge loan today to keep you afloat, but there's a catch. You have to let us run your IPO next year. We'll take a hefty percentage fee for organizing the IPO, and we'll legally write a rule into the prospectus that the public's IPO money goes directly into our pockets to pay off our own loan.
Wall Street never loses.
It's essentially a bank bailout funded by retail investors hyping up a Mars colony.
What's fascinating here is that the IPO is being aggressively marketed to the public as a massive growth event, raising capital to conquer Mars and build AI. But financially, structurally, the primary function of this IPO is a massive deleveraging event.
To fix that balance sheet.
Exactly. By raising $75 billion, instantly wiping out the $20 billion bridge loan, and adding the remaining cash to the equity side of the balance sheet, that terrifying 84% debt-to-equity ratio drops to under 10% overnight. The IPO doesn't just fund the future, it retroactively saves the balance sheet.
And the auditors absolutely know how complex and precarious this all is. Let's look at the audit report, specifically the CAMs, the critical audit matters.
Yeah.
For anyone who doesn't read financial statements for fun, CAMs are the glaring red flags the accountants are legally obligated to point out to investors.
Right, the areas where they essentially say, this math involves a lot of guesswork, proceed with caution.
Exactly. There are three major flags raised by PricewaterhouseCoopers, the auditors for SpaceX. The first is regarding Bitcoin. The prospectus reveals SpaceX holds exactly 18,712 Bitcoin, valued at roughly $1.45 billion.
Making them one of the largest corporate holders of crypto in the world, even more than Tesla.
Yes, and under recent accounting rule changes, crypto assets must be marked to market. This means any wild swings in the spot price of Bitcoin will hit SpaceX's income statement directly. It adds a layer of extreme, unpredictable volatility to their quarterly earnings reports that has absolutely nothing to do with their actual business performance of launching rockets or selling internet.
It's just pure price speculation hitting the books.
Right. Now, flag number two, the Valor $20 billion transaction. The auditors explicitly point to footnote 18, highlighting the related party transaction with Antonio Gracias' private equity fund. They're basically waving their arms saying, hey, we signed off on the math of the lease payments, but you, the investor, really need to look at the ethics and the governance structure of this specific deal.
They want you to read the fine print on that one.
Very closely. And the third flag, which is the sole official critical audit matter, relates to something called percentage of completion accounting. SpaceX engages in massive, multi-year contracts, like launching classified government satellites. They don't wait to recognize the revenue all at once at the very end. They recognize it gradually based on how much of the contract they estimate they have completed.
Explain how that actually works for a reusable rocket, because the auditor points out that estimating the cost of a reusable rocket is incredibly subjective.
It is entirely subjective. If management guesses a Falcon 9 rocket will fly 30 times before it needs to be retired, the amortized cost per flight is very low, and therefore the recognized profit they report today looks incredibly high.
But what if they're wrong?
Well, if that same rocket only ends up flying 10 times, the true cost per flight is much higher, and the profit evaporates. The auditors are warning that SpaceX's current revenue numbers rely heavily on internal management guesses about the future physical lifespan of their hardware.
So if management's guesses are overly optimistic today to juice the IPO numbers, there could be massive downward revisions in revenue in future quarters when the rockets wear out faster than expected.
Exactly, it's a huge risk.
And investors need to be acutely aware of the timeline here, specifically regarding lockup periods. Musk himself is locked in. He cannot sell any of his shares for 365 days post-IPO. However, the other early investors, including those superfan board members we talked about, have a tiered unlock schedule that begins to open up after just 180 days.
Which puts us right around August to December. So if you buy in at the IPO price, you must be prepared for a potential massive wave of insider selling pressure hitting the market right around the holidays as the early venture capitalists who funded this company over the last decade finally cash out their historic returns.
When you zoom out and look at this entire picture, it is the ultimate dichotomy. On one hand, you are looking at a company that has successfully landed orbital rockets backwards, a company that provides life-saving internet to active war zones, and a company that is building AI supercomputers at a speed that terrifies Google and Amazon. They are achieving genuine, undeniable miracles in physics and engineering.
But that undeniable genius is wrapped in a financial and legal structure that asks you, the public investor, to foot the bill for humanity's most expensive dreams, while giving you absolutely zero rights in return.
You really get nothing in terms of control.
You have no vote, no independent board oversight, and no ability to sue when things go wrong. It's incredible. So for you, evaluating this opportunity, the call to action here is deep self-reflection. Before you get caught up in the hype of a $2 trillion valuation, the thrill of a Mars colony, and the speed of AI data centers, evaluate your own risk tolerance. Are you comfortable handing your money to a visionary with absolutely no strings attached? Are you okay being a pure passenger on a rocket ship where you have no say in the destination?
Consider this as a final, broader implication. If a single entity controls global broadband access, the only viable transport to the Moon and Mars, and the largest orbital AI compute clusters in existence, and all of this power and infrastructure is governed by one individual with zero shareholder oversight, zero legal accountability to the public market. At what point are you no longer investing in a traditional corporation, but effectively funding an autonomous sovereign nation-state?
Wow.
Think deeply about that before you buy your shares.
I think my brain just short-circuited. A publicly traded nation state. What an incredible way to frame it. Thank you for joining us on this deep dive into the SpaceX prospectus. Remember to check out the deepvalues.ai community and the Buffett Indicator app to stay informed. We'll catch you on the next deep dive.